I've got a chart that I tweet, and the chart shows that bonds are minus 5% ARR for the past 4 years, and Bitcoin is plus 55%.
Crypto fam, welcome back to the channel. Aaron here from Bitcoin Bros coming back at you with another cryptocurrency video today. And as you just saw, that was Michael Saylor. And in today's clip, he's going to be talking about what is the next catalyst for Bitcoin to send the price higher. This is a good one. This is a recent interview that he did at the Bitcoin conference. Recommend you guys watch this one until the end. He also gives some business advice at the end of this clip as well. And if you guys are new to the channel, subscribe. Check out our Patreon. The link will be in the comment section and the description below. We keep it updated with everything going on in the market and what we think about what's going on and what's going to happen next for BTC and the rest of the crypto market. So check that out if you guys want to. Let's go ahead and play the clip.
So if you're an operating company, by law, you're only up until January of this year. By law, you had to invest your excess capital in treasuries, and you couldn't invest it in the S&P index, and you couldn't, an operating company can't reasonably hold their excess assets in real estate, timber rights, sports teams, and Apple stock. The reason, not well talked about, but the reason Berkshire Hathaway, for example, has so much cash is because they can't buy the S&P index, and they can't buy more Apple stock because they would trip a 40% covenant or a limit that's put in place by the SEC 40 Act. And if the company gets more than 40% of its liquid assets in a security, it's no longer an operating company, and that means it can't take on debt, it can't issue options. It basically blows up the company. You become an investment trust. So for 100 years, 80 years, the law forces operating companies to hold their excess capital in an asset which is losing 5% of its economic energy, 5% of its purchasing power per year. And when 2020 came along, we were pushed in the Bitcoin space, but there are really three crippling defects, three crippling things that keep a company from swapping out bonds for Bitcoin, or basically putting Bitcoin in and bonds out. The first thing is you need the SEC to endorse it as an institutional or a legitimate asset class, a digital commodity, and not a security. It's either illegal, because you can't. It's illegal to own Apple stock, and it's definitely, you don't want to have an unregistered security. So we had to have digital commodity, first step. And we kind of got 75% of the way there in January. It's not a perfected endorsement. It's a grudging endorsement, with reservation. But we crossed the event horizon. You can't turn that back. The second thing that's required is fair accounting. You can't invest in something that you only lose money in and you never make money in. Just simple, right? No one wants to invest and always lose money and never make money. But the accounting rules before January were you can only lose money in Bitcoin. And so nobody is going to buy an asset that always gets written down and never get written up. And so that's optionally fixed in January. That's mandatory, fair accounting, in next January. That's the second leg of the stool. And the third leg of the stool is Google can wire $1 billion to JP Morgan every month and say, put it in T-bills. And it's like 15 seconds. And if JP Morgan loses it, it's JP Morgan's problem. The status quo right now is Google would have to wire $1 billion a month to Coinbase, while the SEC is trying to put Coinbase out of business. And they'd have to cross with Cross River Bank, like a bank you've never heard of. That's the only bank that will actually take the wire. So the CFO of Google is not going to be so interested in wiring billions and tens of billions of dollars to a crypto exchange as a custodian. They want State Street. They want Citigroup. Citibank is the successor to National City Bank. National City Bank was run by the brother of John D. Rockefeller. It was the Rockefeller Bank. So if you want a sense of how long these relationships run, 30 years is a short period of time. So the third piece we need is we need banks to be able to custody Bitcoin, and then they can buy it for you, sell it for you, loan money against it. And then in that world, you will be able to get a margin loan at SOFR plus 50 basis points against your Bitcoin. You will probably get 5% interest. You'll probably get the same interest rate on Bitcoin as you get on a money market fund. And if you had those two things, then a corporate, it's like $100 billion of Bitcoin going up 20% a year, yielding 5% with no risk, and a bank too big to fail is doing the headache for me. You can imagine Apple might say, put $50 billion in Bitcoin. So we don't have that third thing. We're kind of in year one. You could say we're year zero, because year one is when you get the third thing and you get the endorsement without prejudice, you know? But I would say that we're 6 months in. Now you got 50,000 publicly traded companies. They're all capitalized on toxic credit, which is collapsing. You know, one of the points of my speech is if you build your company on a capital asset with a 10-year useful life, your company's going to last 10 years. And so all of these companies have a 10 to 20-year life because they're sitting on a defective capital asset. The driver for them to switch from bonds to Bitcoin is Bitcoin's got a useful life of 10,000 years. If you self-custody it, your maintenance cost is, 1 basis point or something. So the useful life of Bitcoin is thousands of years. The useful life of a bond is a dozen years or 20 years. The regulatory impediment keeps mainstream companies and institutions from doing it because it's too much trouble. And 2024 is that first year. So the reason that they're kind of creeping into it right now is finally you can sort of do it. It's a lot of effort to figure out who you're going to custody with and how you're going to buy it right now. And you can buy it for $65,000 because you're doing the effort. When JP Morgan and Goldman Sachs do this, it'll be easy and it will cost $500,000. So you get 85% discount if you do the work and you take a little bit of risk. If you'd done it in 2020, you would have got a 98% discount. If you came in 2013, you got a 99.8% discount, but that was a lot more risk and a lot more work. And, a lot of these institutions, they're just like, if I can make a phone call in 30 seconds and say, buy $10 billion of Bitcoin, they'll do it. But if they have to work harder, they'll study it for 3 years, and then they won't do it because why should they take that risk? And so we're in that transition. Business is hard. Like launching a business and growing a business is hard. Investing is hard. When you look at every public company, you try to guess if their stock is overvalued or undervalued versus their cash flow forecast. That's hard. It's not hard to say it's a good company. It's hard to say whether the stock price is a good entry point, right? Investing is hard. Saving was hard under the fiat standard, but under the Bitcoin standard, if your goal is, I have some money, I'm going to hold it for 4 years, that's easy. I buy Bitcoin. If I'm going to hold it for 4 years, it doesn't matter what the volatility is. And from there, business is hard, man. Businesses, there's something happening in the world, which is like, how does anybody sell software to a corporation? If Microsoft, look what they did with Slack, look what they did with Zoom. They will just take your Slack and make it Teams and put it into their 3-year enterprise deal, and you have to buy it. And they will take Zoom and put it into Teams and put it in the 3-year deals, and you have to buy it. And it would be easier for a company to leave the US than to leave Microsoft. Just like Apple, not that different, right? I mean, how many people want to throw away their Apple phone and switch to a new ecosystem? They've got your stuff. So business is hard.